Hi, I'm Brooke Thackeray. Welcome to What's Hot and What's Not in the month of December. We've seen the stock markets rally strongly in November, and we're coming up to Christmas very shortly and the New Year as well. Investors are wondering what to expect here. I'm going to talk a little bit about that today from a seasonal perspective. So let's jump right in, and we're going to start by using my THRI's 2024 Investors Guide. This is a public service announcement. The THRI's 2024 Investors Guide is now in bookstores and makes an ideal Christmas gift. A few of the new strategies here are Hormel Foods, Pepsi, Cintas, Schlumberger, Stryker, and more as well. So if you're looking for a Christmas present for somebody special this year, THRI's 2024 Investors Guide. Here we are. This is the month of December for the S&P 500 from 1950 to 2022. You can see here the first half of December, or approximately, we see the stock market can be a little bit volatile. And typically it's a little bit flat. It's the second half of the month that tends to perform well. Now, a lot of people will attribute this to the Santa Claus rally, year-end rally, whatever it is. There's a strong seasonal tendency for the stock market to do well. If we look at the daily probability gains here as well, look around Christmas time. You can see here that the trading days around Christmas, the Christmas holiday, actually perform quite well on a frequency basis. This table shows the average performance for the major sectors of the S&P 500 from 1990 to 2022. It's ranked in the order of the average gain. So the top performing sector has been the utility sector with a 2% average gain in December. Now that's surprising to most investors. It's a very conservative sector, but what investors tend to do in the month of December is they tend to barbell their risk strategy. So they tend to pick up utilities, and on the other side of that barbell is the small cap sector. And so you tend to see them actually perform quite well as a pair. So far, that's actually looking like it could be the case again this year. Industrials is also a top performing sector. Over here, this column shows the frequency of outperformance relative to the S&P 500. How frequently does the sector beat the S&P 500? Materials tends to perform well. So we're looking at some of the cyclical sectors, financials, telecom, healthcare. I want to go all the way down here. Energy, by the way, is actually kind of quite low in the month of December. The sector has not been performing well on a seasonal basis. It tends not to perform well in October, November, and December. So we could be coming to the end of this weaker period here. But I want to go down here and take a look at the technology sector here. Now, this would be a surprise to most investors because technology can actually perform well in October, but it does have a weak seasonal period in early December to mid-December, and it's quite significant, and it really weights this average down. Although if we do see a correction, it can be a good sector to pick up later in the month as well. But you can see in the first part of December, that weak period from after the first few days in December to mid-month tends to really weigh on the sector. And so far, that looks like it's actually playing out as the technology sector is underperforming the S&P 500 in the first few days of December. I want to jump right down here and to some of the subsectors, the list of subsectors here. Home builders actually tends to perform well. Steel, biotech actually, but look at the frequency of outperformance. It's actually quite low, so that means it's being skewed by a few years of good performance. I want to go down the list to this right here. Here we've got gold. Gold is fairly low. It's got, on average, in this time period, it's produced an average gain of 0.5%, and it's outperformed the S&P 500 39% of the time. Silver is a little bit better here, and that's because it's an industrial metal, and we do find the industrial metals actually performing well in this month. So gold, now I want you to take this with a grain of salt because gold can perform well in the month of December. And we saw that last year. We saw that the year before where gold bottomed before its strong seasonal period. Typically, the strong seasonal period for gold starts in late December. But we've seen in the last few years, gold actually started its seasonal period, a rally, earlier. And it looks like it might have been October. But the message here is gold could be volatile. In the month of December, we could see a pullback here before it actually starts its strong seasonal period, which is on December the 27th into late January, and gold miners as well starting on December the 24th. But like I said, it might have been that we've already seen the bottom that's in October, but there could be some volatility here. Okay, I'm going to jump back a few pages. Here. And you can see here the industrial sector has a strong seasonal period from October 28th to December the 31st, and then from January 23rd until May 5th. So this gap, why is there a gap here? Okay, well, that's because the industrial sector and a lot of the sectors in the market tend not to have reliable seasonal patterns in this time period. In fact, the industrial sector tends to be negative in between these two periods here. And on average, unless there's strong momentum in the sector, that's something different. But typically, it's worthwhile to note that there is some weakness in this time period here. Industrials have been performing well recently. This chart shows you the industrial sector using the ETF XLI. Here we can see that strong move in the industrial sector recently from late October. And if we take a look relative to the S&P 500, it's had a strong move recently. That's important because it is one of the top performing sectors in December, so it could have more to go. If we jump back to my book here, you can see the materials sector also has that same gap with approximate dates as the industrial sector for seasonal periods here. It performs well from October 28th until January 6th, and then and there's a gap, and then from January 23rd to May 5th. The same rationale with the materials sector tends to have that weak performance in between these two seasonal periods. Now, if there's a strong momentum for the sector, it can perform well. In fact, I actually mentioned that down here towards the bottom of the page. And just to go up here, this is a note. I'm using the material sector in the U.S., so we're looking at approximately 60% or more in chemical stocks versus the material sector in Canada, which in fact is in gold companies, 60% or more. So totally different altogether. Here we are with the material sector, XLB in the U.S. You can see that strong move just like the industrial sector. And also this is relative to the S&P 500 down here. We've seen a similar move, not quite the same magnitude for the material sector. Also performing well, tends to be one of the top performing sectors in December, so could have more to go. If we look at the metals and mining sector, it starts its strong seasonal period November 19th until January 5th, same gap. And then we've got the second part of the seasonal period from January 23rd until May 5th. The metals and mining sector has actually been performing quite well for most of 2023. I'm using the ETF in the States, XME, for the metals and mining. This is relative to the S&P 500. Look at this breakout on an absolute basis here. We've had a strong rally really it started in November, and we can see that here as well. We've seen a breakout here. I want to point out that look how far back the metals and mining sector has been outperforming the S&P 500. Look at this. This is actually, we did see a little bit of a dip in November, but really this started back in June. This is showing us that investors are attracted to this sector. So right now, I think investors are taking a look for an alternative to the technology sector and the growth sectors. And this sector has been performing quite well as investors have been interested in commodities. They're not sure where to go. This has been one of the beneficiaries. Okay, let's flip some pages here. There's UPS. You can look at that yourself. And if we go through this as well, we got Brinks as well. Oh, this is an interesting one because the seasonal period actually starts December 1st. It's actually a very strong seasonal period for Brinks. Here you can see here just in this chart. Look how often Brinks is positive in the month of December. Some huge numbers, not so much recently in the last couple of years coming into the pandemic and after, but if we take a look at the monthly chart here, look how the average, which is the bar, and the median have both performed particularly well for Brinks. And if we take a look at Brinks right now, this is Brinks here. You can take a look here. We saw the rally from the end of October, but look at the performance as it starts December. Look at that strong performance and outperforming the S&P 500. Right on cue for a strong seasonal period just around the start of December. This page has the Do the NAS with Santa. NASDAQ gives more Christmas, December 15th to January 23rd. This is very similar to the technology sector for obvious reasons. The NASDAQ is rolling over like the technology sector right now, so maybe this happens a little bit later on, but it is something to watch out for. If we come to the next page, this is small company effect from December 19th to March 7th. We've actually been seeing the small caps outperforming recently, which is really interesting. We are just before the strong seasonal period. It looks like investors are rotating into the sector. Even with the market not performing particularly well, investors are showing a favor towards the small cap sector. This is IWM for the small cap sector. This is IWM relative to the S&P 500. Small caps from mid-December to March, early March is the strong seasonal period for the sector. It's important to note that the small cap sectors do have a tendency of rolling over in early March. And we take a look in This is earlier this year. We saw the small caps start to head down in February. And look what happened in March here. We saw that the small caps start to roll over. Go back into 2022. Look at the peak here for small caps. That was a little bit later in March, though. And we go back to 2021. We can see here that early March here, these sectors sort of petered out. And relative to the S&P 500, this really was the start of, and after performing well in a strong seasonal period, this was the start of the underperformance here. And we've seen this really long period of underperformance. We've seen a little bit of a rally early here in late November, early December for small caps, despite the market actually picking up in volatility here. This is quite interesting. We are seeing this real attachment or favor towards small caps at this time. This page shows the U.S. financials performing well from mid-December to mid-April, but I do want to point out that if we take a look at this graph down here, this is the financial sector relative to the S&P 500 from 1990 to 2022. You can see here there's not a really strong seasonal trend, and the dispersion of returns relative to the S&P 500 is quite large. So it's very difficult to really have a lot of confidence in a strong seasonal trend for the financial sector. It can present some opportunities, though. If we take a look at the monthly returns here, we can see the crosses, which are the median, and the bars, which are the averages. Here we do see some strong outperformance that can occur at different times of the year. But look at this graph down here. This is the frequency of outperformance relative to the S&P 500. And you would typically want to see, it's the frequency that really matters the most here. But I do want to point out that really it's January and February that tends to be the two better months for the U.S. financial system. So perhaps there might be a little bit of a period here where we could see the financials perform quite well relative to the market. I want to show you some graphs of some other key sectors that are either in their strong seasonal period or coming up to their strong seasonal period shortly. Let's start with the energy sector using the ETF in the States XLE. This is relative to the S&P 500. Now, the energy sector tends to perform poorly on a seasonal basis in October, November, and December. And look at this here. What we've really seen is we've seen that weak performance in this time period again. But the strong seasonal period for the energy sector starts up again in late February, but it can start up in January as well. So we're not too far away from that, particularly if we do see the sector actually get hit hard. This graph shows gold here, and the gold has a strong seasonal period from December the 27th until late January. We've seen the rally in gold actually start early this year. It started in early October, and that's actually been happening a bit more over the last few years. We saw that last year where we saw gold start to rally in November. And then the previous year, if we take a look here, we can see that gold actually started in late September. Look at that move that it did in 2021 and going into 2022. The move so far for 2023 is less than what we saw in 2022. In fact, well, it went higher here and also in 2021. So we could have started the strong seasonal rally early this year, but according to what we're looking at as far as the magnitude goes relative to the last couple of years, we could have more to go. We did reach an all-time high. Wouldn't be surprised to see if we pull back here a little bit. This graph shows gold from the year 2006. So we're going back quite a ways here. But I want to point out that here, in fact, what we've got is we've got a cup and handle formation. And that is a very bullish pattern in the marketplace. We've just seen gold break above that recently, which is also bullish. It would not be surprising to see gold pull back below 2,000, particularly in December. We do see some volatility for gold. It tends to be, on average, one of the weaker performing months, and usually represents a good opportunity as far as an entry point late in December. But we can see it happen earlier, just like we saw last year, and just like we saw the year before as well. Just because we see some volatility here doesn't necessarily mean that the opportunity on a seasonal basis is finished for gold, because we haven't even started the strong seasonal period for gold at this point. Here's gold miners represented by GDX. If we take a look here, we can see that gold miners recently had a breakout, just like gold did as well. But look here, gold has reached an all-time high, but look how far the miners are off their highs in 2002 and also 2003 this year. So on relative performance, we have seen some weaker performance for the miners, but they have a strong seasonal period from December 24th and into February, and once again can go into March. This is silver. It is a strong seasonal period that starts in late December until February. Now, once again, it tends to be volatile in the month of December, and if we see a correction that happens in December, it tends to be a good buying opportunity later in the month as well. So we could see some good opportunities there. But compared to gold, we're still off those recent highs from 2021. We're also below the 2022 high. We're still below the 2023 high earlier this year as well. We have seen a little bit of a run here. This is relative to gold. We have seen some outperformance here, as we've seen the metals and mining sector also perform well. But just recently, we've just seen a little bit of a drawback here for silver versus gold. But overall, if we see the metals and mining sector perform well, the market perform well, and gold perform well, my bets in that case would be on silver over gold. Now that we've looked at the seasonal period for some of the sectors in the marketplace and also taken a look at some of the charts on them, I want to show you another tool that I use, which is the relative rotation graph. And this compares the sector's momentum and ratio performance to the S&P 500, at least the way I've set it up here. I want to show you how that corroborates with some of the information we've been talking about. This is the relative rotation graph. It's provided by Stock Charts here. It's also been on Bloomberg since 2011 as well. And this RRG graph, the bottom axis is the ratio, the relative strength ratio. That's, in that case, it's the sector divided by the S&P 500. And this vertical axis here is the relative strength momentum. So the momentum of the sector divided by the momentum of the S&P 500. And as we move up here, that means the momentum is getting better for the sector relative to the S&P 500. Now, the quadrants in this graph, here we have leading. This means that it's a leading sector, weakening, lagging, and improving. Obviously, improving and leading are ideal quadrants, but it still can be a good opportunity for a sector if they're moving up from lagging and they're coming up into improving here as well. Generally speaking, in this graph, in the context of this graph, you'd want to avoid sectors that are weakening relative to the S&P 500. Now, here's the XLK. So this is the technology sector. And if we take a look here, these dots here, this is the last 7 trading days. You can see that it's moved out of the leading position quadrant and it's come down to the weakening section. So we have seen some weakening for the technology sector relative to the market here. And it could be showing that, that lines up with the seasonality because typically the technology sector tends to be weak in the first half of December, as we discussed earlier in this video. And if we take a look here in this quadrant, what we've seen here's XLU. Okay, look at this improving performance. Although it's been lagging, but it's now moved into improving, and it's been showing that strength here, which is a good thing for the sector. Look at the energy sector here. So the energy sector was lagging. In fact, if we went back and showed a bigger tail, some more trading days, we would have seen that. We've seen this happen here. Now it's still. It hasn't moved into the leading section yet, and we are still before the strong seasonal period for the sector. If we take a look at a couple of the other sectors, here's the material sector here. It is showing some good signs here. It's moved into the leading. It typically performs well in the month of December. Industrial is also here as well. This is the financials. If we take a look here, I just showed you the technology sector. If we take a look at this one here, that's the communication sector, another growth sector not performing well. And also, too, the other growth sector here is the consumer discretionary sector. It's showing some weakening as well. So what we're seeing is a shift in the marketplace from the growth sectors of the market into some of the cyclical sectors, such as the material sector and industrial sector as well. So what should we expect in the month of December? It's probably going to be a volatile month. We've seen a strong rally in the market recently. It's become overbought. Wouldn't be surprised to see the market do some backfilling in the first half of the month. And then we could see a rally that takes place a little bit later on in the month from there. I think the big narrative going on here is we are seeing some weakness in the developing in the growth sectors of the market. So where are the investors going? Well, right now we're seeing some interest in the cyclical sectors of the market. Also, too, the small caps are performing well ahead of their strong seasonal period, just ahead of the strong seasonal period. And we're also seeing utilities, the defensive sector, outperform. It's going to be interesting to watch because December, the narrative of the market can flip, particularly if we've seen a strong year take place. and a strong narrative really carried the market, which we have seen this year for the Magnificent Seven. And if we go back to 2021, in the month of December, what we saw the defensive sectors, the utilities, consumer staples, and healthcare outperform the S&P 500 while the S&P 500 moved higher and interest rates moved higher. That was a unique combination. What it was doing was it was telling us that the investors were in the market, but they were starting to get defensive. And then what did we see in early 2022? We saw the market turn down lower. I'm not saying that's going to happen this year, but it's something we should watch out for. Also, this December could be interesting from a tax loss selling perspective. We've seen a large dispersion of returns. Some stocks made some large gains this year, and we've seen a lot of stocks not do well this year. So that could drive some real sector rotation happening this month as well. So far, we've seen some interesting combinations take place. The small caps have started to outperform a little bit early, and utilities. And I talked about the barbell risk allocation for investors. Sometimes it happens in December. That looks like it's shaping up as well. So it's going to be an interesting month to see what the narrative is going to be as we develop, especially if investors really start to move away from the technology stocks on a continual basis into the month of January. Now, we could just see a pullback happen in the first half of January, and then the technology stocks and the NASDAQ start to rally in the second half of the month, which on a seasonal basis they tend to do. But if that doesn't happen, that's telling you that we're seeing a little bit more of a shift in the market. It's going to be an interesting month once again. Thank you very much for joining me today.